Gold, okay, it is down over the past day, let's call it, but still ahead over the past month. And our guest thinks it is a pretty good bet to help investors ride out the stock market volatility that he sees ahead. David McAlvany joins us now, CEO and Portfolio Manager at McAlvany Financial Companies. Thanks very much for coming on the show. Give us the number one reason why you think investors should own gold right now, David.
Yeah, I think if I was picking one reason that has some durability to it, it would be that we have a fiscal position here in the U.S. and in many other parts of the world, which is simply unsustainable. We've accumulated too much debt. Deficits continue to rise unnecessarily. We're not at war. We're not in a major economic crisis. And yet, in the U.S., as an example, $1.9 trillion in new deficits this year. That is not responsible from a political standpoint, and it's not sustainable from an economic standpoint. So we're getting to the point where we have terminal math that is going to translate into currency pressures and bond market pressures at some point. And I think that people should be looking at gold as a ballast asset within a portfolio, something to bring real stability for what we have ahead.
You know, it is true. I mean, Keynesian economics would say in bad times you run deficits because the economy needs propping up, but we seem to be in eternal propping up mode.
Yeah, well, it's a consequence of democracy. And it's as much as I love democracy, it's part and parcel to it. When you have the exchange between people who want to be shown how they're going to be taken care of, and they're willing to exchange their vote in part for what they receive from the Treasury. This is sort of the dark side of democracy, is that ultimately, fiscal conservatism is incompatible. It's incompatible with democracy. That is the state of play. It has been for many decades. We're just now getting to the point where the math is terminal. This year is a classic case in point. We will, in the U.S., spend more on our interest component than our military spending. You tell me if that's sustainable. I don't think so.
Of course, well, heaven forbid we go into dictatorship. I don't know if it'll be any better, though. You'll have a crony of advisors, and but in any case, let's not. But the democratic deficit, we've heard about politicians. They feel forced to only have their horizon 3 or 4 years out.
Yeah, and I think it really is a bipartisan issue when it comes to spending problems. When we think of the world of tomorrow, we have a high probability of an inflationary outcome if Trump were to be reelected. But I do think that the fiscal pressures are existent whether you have a Democratic win or a Republican win. So I think the other thing that people are looking at, particularly in the gold market, and this has been constructive all year long, I'd say the last 12 months, is a growing number of people who are looking at instability within the financial markets, and they want a safe haven. And this is, I think illustrated well this week with the blow up in the yen carry trade. You had two things happen last week. You had Jerome Powell basically say, here we come with lower rates in September. And that combined with the Bank of Japan raising interest rates, you've got a run for the yen and a short covering rally that is really indicative of this massive multi-trillion-dollar trade in the classic carry trade. Evidence all over the place if you're looking at emerging market currencies of the carnage which was accruing, and it was an absolute requirement that the Bank of Japan basically recant a part of what they were trying to do last week.
You think that the U.S. cutting interest rates, when and if it comes, I mean, the market, last time I looked, thinks it'll be next month. You think that could worsen instability in financial markets?
Absolutely, because the unintended consequence is it puts downside pressure on the dollar, at least as it relates to the yen carry trade. So downside pressure in the U.S. dollar and an improvement in the yen's position. So it just depends on how close you are to the edge with yen carry traders. And in this case, what we found last week is that we were very close. Perhaps things have stabilized now. It remains to be seen if we've sort of done with the worst or if there's a lot more to come. I mean, we are talking about trillions upon trillions. This is one of the largest leveraged bets that's been put on, and it's been put on not over a 6-month period, but over actually several decades.
You mean, a bet on lower U.S. interest rates or the yen trade, the yen carry trade?
On the yen trade. Just given the Bank of Japan's sort of perpetual zero interest rate policy.
And why has the Bank of Japan moved to change its mind and actually increase the cost of money? I know very marginally.
Yeah, well, I mean, I think the move from, 140 to 150 to 161, as you began to see a deterioration in the yen, they had to do something because you're getting very close with two currencies, the Japanese yen and the Chinese yuan or renminbi. They were both on the edge of breaking down. Deconstructing. And so the raise in interest rates for the Japanese was one way of saying we are going to bring some stability to downside pressure on the yen. And now all of a sudden we've got the combination of upside pressure. And that's why I think Jerome Powell's decision last week was also critical to those two things in concert, taking the yen to a much more stable place, 161 to 143 in a matter of days.
The gold miners making plenty of money with gold at almost 2,500, plenty of cash flow.
They are, and I think this is what is sort of underappreciated. You look at a company like Alamos, a realized price in the second quarter of $2,336, all-in sustaining costs of $1,196, and a decrease of 13% in that all-in sustaining cost for the quarter. This is phenomenal. They're making a lot of money. I think of Agnico Eagle, one of my favorite companies, and again, this is, they're on track for $2 billion in free cash flow, $2 billion in free cash flow for the year. It's a very impressive performance. $596 million in terms of quarterly free cash flow for Newmont, 557 for Agnico Eagle, 87% year-on-year improvement. This is a really interesting story, and I think this is what people have failed to appreciate. The whole sector has been left largely alone because the sector hasn't made money for a long time. But the management teams and the executives of these companies, they've smartened up. They're far more conservative. And now you're actually seeing higher prices have a very constructive impact. So that I think is something that is a change. There are some positive surprises yet to come. Newmont comes to mind in that regard. I mean, you've got higher all-in sustaining costs, not particularly impressive in the last quarter, but you've also got guidance full year still in the 1,400 range as the company divests their higher cost assets. And these are all tier one jurisdiction assets that they're selling. Tom Palmer said we've got 15 to 20 very attractive bids on every one of these assets. So as the price of gold has stayed higher, the bidding for these tier one assets has been impressive. They may end up with $2.5 billion instead of $2 billion with something to do with. Quite a little war chest. And that in itself, once they get rid of the non-core, which have sort of an average all-in sustaining cost of $1,770, will bring their total all-in sustaining costs for the best assets that they retain. 2025, their all-in sustaining cost should be $1,300. What's not to love? Now, I guess the big thesis with the precious metals miners is, do you think that the gold price is sustainable? Do you think that this is a sustainable party or not? And I think that there is a case to be made.
Finish your thought, because we are out of time. Just finish your thought very quickly, if you would. Sorry, David.
Yeah, I think there's a case to be made for having gold as a ballast asset, given geopolitical instability, the frailties just under the surface within the financial markets, and the unsustainable nature of the way that a number of governments around the world, big ones in the G7, have managed themselves into awkward, unsustainable positions. That, I think, argues well for owning gold.